Well, concerns over a rate hike next week are easing slightly after today's inflation data was in line with the central bank's forecasts, although it was higher than what Treasury had predicted just a few months ago. CPI rose 1% in the June 2024 quarter, bringing annual inflation to 3.8%. This was Treasurer Jim Chalmers' response, saying that inflation is still easing despite the rise. Have a look.
We know that people are still under pressure, and this inflation in our economy is more persistent than any of us would like. But there are some, within the data, there are some welcome developments, even though inflation overall is still sticky and stubborn. We've got to get on top of this inflation challenge in our economy without smashing our economy or without smashing jobs.
But Shadow Treasurer Angus Taylor had a different take. He insisted inflation was now homegrown.
This is homegrown inflation. This is Labor's homegrown inflation, inflicting pain on every Australian household.
All right, Judo Bank's Chief Economic Advisor Warren Hogan joins me now. Thank you very much for your time. Now, it did rise to 3.8%, so the Treasury had forecast it was going to be 3.5% at the middle of this year. They were then forecasting that by the end of the year it would be down to 3%. That's getting very close to the target band of 2 to 3%. So we're seeing that the Treasury was more optimistic. But given it was in line with where the RBA expected inflation to be, do you think they're therefore less likely to raise rates at their board meeting next week?
Yeah, we were worried today's number would be a bad number because the monthly numbers for April and May had been. And we thought there'd be a smoking gun for the RBA. But as it turned out, we got a more moderate number. It's still a bad number. We're still getting inflation of 1% in the quarter, 4% annual rates. So the smoking gun's not there. But the RBA could easily say, look, it's sort of coming down. We can wait for another 3 months. But by the same token, the case for higher rates is quite clear, and that is inflation has stopped falling. It got to 8, it's come down to 4 late last year, and now it's just going sideways. And even though today's data didn't bear out the worst, it's still not telling us that inflation's heading to target. So the RBA has a case to go, on top of the fact that we're creating a lot of jobs. And of course, the big one is there's a huge fiscal stimulus about to hit the economy. Well, he's hitting it right now, and tax cuts and subsidies and so forth.
Well, the Treasurer seemed to be urging, not directly, of course, you know, he says he would never tell the independent RBA what to do, but he seemed to be urging the RBA in his public commentary to hold off because he's saying that when some of the extra subsidies hit, that will lower inflation. You know, this is part of his argument that his budget is deflationary. Do you think that proposition's accurate?
No, it's not. I mean, it's a narrative for the broader community, and it's obviously a cost of living measure which is helping people in terms of their budgets. But in terms of the inflation process and what worries the RBA and the idea of getting inflation out of our economy, throwing money at the economy is not a solution to inflation. In fact, it adds to it. And I think the real risk here is the RBA chooses not to go next week because of this broader pressure on them to not raise rates, because this number wasn't as bad as feared. But as the stimulus that's coming through with tax cuts kicks in and the economy starts to look a bit better, and the next inflation number is no better, if could be even worse, then if they raise rates later in the year, then the government's got nowhere to go. And it'll be clearly because the fiscal stimulus is hit, and of course the inflation's not going away. So in a way, you could argue the government should want to hike next week because that sort of is a hike not related to their fiscal stimulus. But it's coming, and there's some early signs that people are responding positively to the tax cuts, as you'd expect.
The Treasurer has argued that because of their energy subsidies, that component of inflation was much lower than it would have been. What happens when those subsidies end in about a year's time?
Well, the inflation goes back up. So if electricity is 100 and it goes to 110, but the government gives you a subsidy and says it's only going to cost you 105, the electricity generator is still getting 110, but the CPI says it's only going up to 105. But in the following year, they remove the subsidy. The consumer pays 110, and even though the electricity price hasn't changed, the CPI will measure it as an increase. So it's just a mask in terms of inflation. So if you remove the subsidy, inflation will go up. So the RBA has said quite clearly they're going to look through it. I mean, this is something economists have understood for decades. These are tricks in terms of the measurement of inflation rather than what's actually out there.
So you think the RBA will still have to raise rates, but they might shift it towards the end of the year, responding to some of the public pressure, or maybe it's just not urgent for them to do it right now? Yeah,
well, I mean, there is a lot of pressure. And it's not just this sort of political pressure from political leaders, but they are concerned about their position in the community.
Well, 13 rate rises, it's hurting. People are having to sell their homes.
It is, but the reality is the inflation is what's doing the damage to people's standards of living, particularly the most vulnerable in our community. And it's their job to get rid of it. So it's a judgment call, but I still think that the level of the cash rate is not high enough and that we will need to see further rate hikes. And the sooner we do it, the less they'll have to be. So it's really, the RBA is really, it's a big meeting next week. Most people think they're not going to move. I still think there's a chance they will because I think it's the right thing to do. But I don't think we're out of the woods on rates or inflation by any stretch of the imagination, just because this number today came in a touch better than expected.
Yeah, well, and even the Treasurer says it's sticky and stubborn. Now, let's have a look at Rex Airlines. It has gone into voluntary administration. It's already fired 360 employees. It's axed their capital city flights. More jobs are on the line. More flights are up for being cut as well. This is really impacting regional communities. Do you think there's anything the government should be doing?
Yeah, well, look, the process has got to have a look at what can be retrieved. So they've gone into these new routes in the last few years, in the capital city routes. That hasn't worked. Can they get out of those routes and still have a business, the one we know in regional Australia? If they can, great. If not, I think there's a case for the government to provide some support, whether it's the state governments or the federal. But this is a crucial service. We know that the airline industry is difficult, and of course Rex is a really important service for Australia. So I think there is a case for government as long as it's a transparent process that shows that it can't be saved on its own.
All right. Warren Hogan, thank you very much for your time. Appreciate it.
Thanks, Sharri.
And it's been a big day for you, I know, analysing all of this data.